What's up, everybody? Joe Brown here. This is the Heresy Financial Show. Got a question for you. Do you remember your first job? More importantly, do you remember your very first paycheck? Because I certainly remember mine. It was a very traumatic experience for me. My first shift was 4 hours long. I worked at a movie theater, sweeping the floors, picking up trash. First shift was 4 hours long. And it happened to land on the last day of the pay period. So a couple weeks later, I went in and I picked up my paycheck from the front desk, opened it up. I was excited. Total compensation before taxes was $32. And after taxes, it was like $15, $16. So I thought there must be a mistake to this. So I looked at the pay stub and sure enough, a bunch of taxes taken out, Medicare, Social Security, all of that. So I thought to myself, I was like, they made a mistake. I shouldn't be getting taxed on all these things. I'm not using these services. I'm not using Social Security or Medicare. So I went to them and I said, hey, you made a mistake. Why are you taking all these taxes out? I'm not using these things. And they said, yeah, welcome to work. Welcome to paychecks. Welcome to taxes. And that was my first foray into the world of paying taxes, which are essentially forced payments for things that you're not going to use, because that's what taxes are. They are a wealth transfer from one person to another. And at this time, we are currently experiencing yet another push from the administration to do something where they will transfer even more wealth from one group of people to another group of people. In this case, trying to introduce a wealth tax. A billionaire tax is what they are labeling it as, but it is a tax on unrealized capital gains. So in this video, we are going to talk about why this proposal is dead on arrival. You don't have to worry about this proposed unrealized gain tax. It is dead on arrival, even if Congress pushes this through and makes this thing law. The Supreme Court will not allow it. Ready? Let's dive in. All right, so to understand why a proposed tax on unrealized gains is unconstitutional and dead on arrival, we have to understand where taxes came from as part of American history. So the American tax system does have a long and complicated history, but what we're going to focus on right now at first is the income tax. The income tax was started in 1913, the worst year in American history, as that was also the year that the Federal Reserve was started. So not a good year in terms of setting precedents for future generations. In any case, the income tax was started. Now, before that point, an income tax was labeled as unconstitutional by the Supreme Court. It was considered something that the federal government was not allowed to do, and here's why. The Constitution states that taxes, direct taxes, must be done through apportionment, which means that they have to be done by the population of states. And so if you're going to tax income, one state that has a certain population will get taxed given how many people they have. And if the next state over only has a tenth of the population, that means that population, well, that state will have to pay 1/10 the taxes. That is what apportionment means. And an income tax is a direct tax. So the 16th Amendment basically gives an exception to income taxes that says the federal government can tax incomes, which are a direct tax, without regard to apportionment. In other words, they don't have to pay attention to the population of the state to determine what the residents of that state will be taxed. They can tax income directly for each individual. So what does that have to do with the wealth tax, the unrealized gain tax? Well, number one, you're going to have to decide how that tax is going to be proposed. Is this going to be a direct tax, or are you going to classify it as an income tax? So let's attack both of those potential proposals. Let's say it's just going to be a direct tax on wealth, on unrealized gains. So let's go that route. Well, number one, what does the Constitution say has to happen to direct taxes from the federal government? It's got to be by apportionment. So that's the last thing they would want to do, because the states with the most populations are going to be the ones that are hit heaviest. That's never going to make it through Congress. The residents of that state are never going to let their representatives push that through. And nobody would think that was fair in America. Any policymakers would be voted out of office the moment they voted for something like that. If somebody was a resident of a state that said, hey, we're going to get taxed way more on our unrealized gains simply because there are more people that live in this state. And so your first option is not going to work. You are not going to be able to label that as a new direct tax. Otherwise, you'd have to do it by population of states. So what's the second option? You could reclassify unrealized gains as income so that it falls under the exception given in the 16th Amendment that the federal government can tax income without regards to apportionment, even though it's a direct tax. Well, the problem with this is that unrealized gains are not real. And I need to make a caveat here because there's a difference between tax reality and trading strategy. If you're investing or trading, you need to treat unrealized gains as if they are constantly realized gains. Same with losses. You need to treat unrealized losses the same as if they are completely realized losses 100% of the time. If you're looking at a position that's at you're losing a little bit on it, you constantly have to be asking yourself, given the new information that I know about this, if I didn't have a position, would I open up a new position at this current price? And if the answer is no, you need to immediately close it out because that's the exact same thing. Trading strategy and investing strategy, though, is very different than tax reality. From a tax reality standpoint, unrealized gains are not real. Consider this. The only reason that when you sell a stock and you get cash for it at the current market price for those shares is because there is a buyer. It is because somebody else wants to give you cash for those shares at that price. Now consider what would happen if literally all shareholders of a stock, of all stocks, let's say, wanted to sell all of their shares. Well, if literally 100% of people are trying to sell, then there are no buyers because by definition in this example, everybody's a seller, which means the price is immediately zero because there's no one willing to buy at any price and everybody wants to sell at the given price. That means the actual value at that moment would go from 100 trillion for the stock market to zero. It would evaporate. Meaning at absolutely zero, that would go from all the value to none of the value in one moment, which means the unrealized gains, when you push it to the full extent of what an unrealized gain actually is only the potential of income dependent on somebody else coming in and turning it into income for you. It is not real income yet. And the Supreme Court agrees with this. The Supreme Court defined income in Commissioner versus Glenshaw Glass in 1955 and stated that it is undeniable access to wealth, clearly realized, and over which the taxpayers have complete dominion. And if the potential for you to access that wealth depends on somebody else granting you that access by providing you that income, that means by definition it's not income. And another case that illustrates this even further is from 1920. It is Eisner versus Macomber, which states that a dividend paid in stock rather than cash is not income because it's an unrealized gain. No money into the investor's hand. It's stated that in this example, every dollar of his investment still remains the property of the company, has all the business risks, which could result in wiping out the entire investment. And right now you might be thinking of the inheritance tax. And you might be thinking to yourself, hey, this sounds a lot like a wealth tax, an unrealized gains tax. How is that allowed, given everything that we've just talked about? Well, the key thing here is the transfer of this wealth. An inheritance tax is a tax on inheritance, which is wealth that's transferring from one person to another. That is very different than an unrealized capital gains tax where no wealth has traded hands. So in the end, I would not worry about this tax proposal. Number one, most of the time when presidents submit tax proposals, it doesn't go anywhere at all. Number two, it would be political suicide for anybody in Congress to try and push it through in its current form, going after it as a direct tax, which would have to go through apportionment. And number three, the Supreme Court would not be able to uphold redefining unrealized capital gains as income, given the precedents, the case law that has existed. That's how this thing works. They look back and they say, hey, well, every time something like this has come up, we've defined unrealized gains as not income. Therefore, since this is not income, we cannot tax this under the exception given in the 16th Amendment. So for those reasons, I believe this is dead on arrival, and it is not helpful whatsoever to dwell on it, to think about it, to worry about it, to try and plan for it. It's most likely not going to happen. As always, really appreciate you guys. Thank you so much for watching. Have a great day.